Welcome to the Deep Dive. We break down earnings calls so you don't have to. Today we're diving into Xerox Holdings Corporation's Q2 2025 earnings call. And, well, there's a lot to unpack here. Some pretty significant financial misses, but also this huge transformative acquisition. We're here to help you sort through it all, understand the strategy, and get a clear picture of where Xerox might be heading.
Absolutely. This call had quite a few moving parts. We'll connect the dots on how management's positioning Xerox for, well, a new chapter, really, but they're doing it amidst some very real, very tangible near-term challenges.
Okay, let's jump right in with the headline numbers for Q2 2025. It was definitely a challenging quarter for Xerox. The results came in below what the street was expecting on several key metrics. They reported an adjusted loss per share of $0.1164. Now, teaser. They were looking for a 10 cents profit.
Yeah, that's a pretty significant miss, not just a little short.
Right. And GAAP EPS also came in at a loss, $0.87 per share.
And then there's revenue. It landed at $1.58 billion. That was just slightly under the $1.59 billion people were looking for, down about 0.1% year over year, or 1.1% if you look at constant currency.
Okay, so revenue basically flat, but the profit miss was substantial.
Exactly. And what really stood out, I think, was the free cash flow. It was actually a use of $30 million.
The use of cash, yeah, not generation.
Right. And that, alongside an adjusted operating margin that dipped to 3.7%, that's down 170 basis points from last year.
1.7 percentage points.
Correct. Those figures certainly got the market's attention, led to a pretty noticeable negative reaction right after the release.
Okay, let's unpack that a bit more. That big adjusted EPS miss, the negative free cash flow, clearly central to the market reaction you mentioned. Rolanda Getsai, the CFO, she detailed the numbers, also pointing out operating cash flow was negative $11 million. So what was management's story? What were the explanations for these, weaker results, especially in Q2?
Well, management, led by the CEO, Steve Bandrowczak, basically linked the weaker Q2 to three main things. First, tariff headwinds, that's been an ongoing issue. Second, higher financing costs. These were costs they took on before the Lexmark acquisition actually closed, so sort of prepaying for that deal.
Okay. Paying the interest before getting the benefit.
Pretty much. And third, just a more cautious outlook on demand for print equipment.
Right. John Bruno, the COO, he got specific about that print demand, didn't he? Mentioned April and May were soft.
He did. He specifically noted softer print equipment demand then. He attributed it to what they called peak doge.
Peak doge, okay.
Yeah, it sounds a bit strange, likely related to, U.S. government budget cycles, timing issues, and also general uncertainty around tariffs, especially hitting those federal and state or local government accounts.
So a bit of government budget funkiness and tariff worries impacting sales.
Seems like it. But he did say demand picked back up in June, which is maybe a positive sign.
Okay. But here's where it gets really interesting, I think. Despite that tough quarter, the Lexmark acquisition was a huge focus. It closed in July, right after the quarter ended. And management sees this as absolutely central to their reinvention strategy. So what does Lexmark actually bring to the table for Xerox?
Yeah, the Lexmark deal is really positioned as the cornerstone of this whole reinvention. The idea is to strengthen and, importantly, diversify their print business. It significantly broadens their A4 product lineup, the standard office printers and multifunction devices. And crucially, it gives them much better distribution channels, especially in the Asia-Pacific region. That was a key gap.
So filling product gaps and expanding geographically. Makes sense.
Right. And management also emphasized unifying the managed print platforms across both companies. And here's a key update. They now expect over $250 million in cost synergies within 2 years.
Oh, that's up from the original estimate, isn't it?
It is. Originally, it was over $200 million, so they've bumped that up. Suggests maybe they see more overlap or efficiency opportunities now.
Okay, $250 million plus in savings. And what does the combined company look like, sort of on paper?
Well, on a pro forma basis for 2024, just looking back, the combined Xerox and Lexmark would have pulled in about $8.6 billion in revenue and generated $873 million in adjusted EBITDA. Importantly, about 65% of that revenue would have been recurring.
That recurring revenue piece is key for stability, I imagine.
Definitely. It's a big part of the appeal.
So Lexmark is huge, but what else is part of this reinvention strategy they kept talking about?
It's pretty broad, actually. It focuses on commercial optimization and operational simplification. Sounds a bit corporate jargony, but...
Yeah. What does that mean in practice?
Well, things like expanding their inside sales program into new areas and product lines, Reducing order processing times, they mentioned cutting 4 days at their XPS unit. That's tangible efficiency.
Okay, making things faster, smoother.
Right. And continuing to push cross-selling of their IT services into that existing print customer base, that's a big growth hope. They also mentioned achieving double-digit percentage cuts in adjusted organic operating expenses, using tech for efficiency, and even insourcing the purchase of Xerox's own IT assets to save money.
Okay, so trimming fat, speeding things up, and pushing into IT services alongside the big Lexmark integration. Lots of moving parts.
A lot.
So how did all this impact their updated financial guidance for the full year 2025? And what are they signaling for 2026?
Okay, for FY25, the updated outlook. Well, revenue growth is projected at 16-17% in constant currency, but that includes about $1 billion from Lexmark, kicking in from July 1st. So Lexmark is driving that growth number.
Right, got to factor that in. What about margins and cash flow?
Adjusted operating margin is now expected around 4.5%. Lexmark is contributing about $100 to $110 million of that. But the free cash flow guidance took a hit. It was reduced to approximately $250 million.
Okay, why the reduction there?
Mainly two things. Higher cash tariff expenses during the year. They put a number on that. $35 million net impact for the year. And also $50 to $75 million in cash payments, specifically to accelerate the implementation of those Lexmark synergies.
So spending cash now to hopefully realize those bigger savings faster.
Exactly. An upfront investment for future payoff, but it hits the current year's cash flow.
Got it. And looking out to 2026?
For 2026, they see Lexmark revenue being relatively flat year over year, which, interestingly, they frame as better than the assumed industry decline.
So holding market share, essentially.
That seems to be the message. They expect significant year-over-year growth in adjusted operating income, though, driven by having Lexmark for the full year, realizing those synergies, and other reinvention savings kicking in.
Good.
They also mention an adjusted tax rate around 35%. And importantly, for cash flow, they anticipate a benefit of about $400 million from reducing finance receivables.
Okay, that finance receivables piece sounds important for the balance sheet.
It is. It's a non-operating source of cash, but critical given the debt they took on.
Which brings us to the next logical question. With all that Lexmark debt, what's the top capital allocation priority now?
Oh, they were crystal clear on this. Debt reduction. Unequivocally number one. The target is to get the gross debt leverage ratio down to 3 times trailing 12 months EBITDA over the medium term.
3 times. Okay.
Yeah. And they pointed to actions they've already taken, like cutting the dividend ahead of the Lexmark deal, specifically to preserve the balance sheet.
Right. That was a big move.
And they expect over $600 million in cash proceeds just from reducing those finance receivables by 2027. That cash is specifically earmarked for debt repayment. So very focused on deleveraging.
Okay. So we've got this challenging quarter, immediate headwinds like tariffs, but this very ambitious long-term strategic vision with Lexmark and the reinvention. How should investors try and interpret all this? We saw that sharp negative stock reaction. Stocks lagged the market quite a bit over the past year.
Yeah, it really highlights that classic divergence, doesn't it? Management is focused on and talking about the long-term prize, the Lexmark integration, the shift to IT services. But the market, at least initially, zeroed in on the immediate issues. The profitability miss, the lower free cash flow guidance, the tariff impact, short-term pain versus potential long-term gain.
And the underlying print market is still tough.
Absolutely. It remains structurally challenged. That's the backdrop. And the tariff uncertainty adds another layer of near-term risk for equipment demand and costs.
So what are the key things investors should watch for? What are the catalysts that could actually shift sentiment and drive performance?
Well, several things really need to go right. First, hitting, or even better, exceeding that updated $250 million plus Lexmark synergy target. Timely realization is key.
Execution on the integration.
Exactly. Second, getting more clarity on tariffs and finding ways to offset those costs effectively, probably through pricing. Third, showing real continued growth in IT solutions billings. They need proof points that the cross-selling is working and that strategic pivot is gaining traction.
Demonstrating the shift is real, not just talk.
Right. And we'll also be watching for a margin improvement story as those Lexmark manufacturing and toner synergies hopefully start to scale up. Management's overall projection is for about $500 million in total savings and profit improvements by 2028 from everything Reinvention, Lexmark, IT savvy.
$500 million. That's the potential prize.
That's the potential, yes. If they execute, you could see a shift from just stabilizing revenue to actually rebuilding margins significantly. But if they stumble on execution, that cash flow and the debt leverage targets could remain under real pressure.
High stakes, definitely. Okay, let's shift gears for our wild yet plausible trade idea. Given Xerox's really aggressive debt reduction target, aiming for that 3 times leverage, and those substantial synergies they now expect from Lexmark, here's a thought for the true contrarian out there. You could consider maybe a long position in a longer-dated, out-of-the-money call option on Xerox.
Okay, an options play. What's the thesis?
The premise is this. Management seems very committed to hitting that debt target. They cut the dividend, showing discipline. If, and it's a big if, they successfully nail those $250 million plus Lexmark synergies A&D, generate that $600 million plus from finance receivables by 2027, well, the deleveraging story could happen faster than the market is currently pricing in.
So betting on faster than expected balance sheet repair.
Exactly. Combine that with potential stabilization in print from the broader A4 portfolio, plus actual momentum in IT solutions cross-selling. You could get a scenario where the market significantly re-rates the stock if these operational and financial targets are hit.
The call option gives you that leveraged upside if the turnaround story plays out.
Right. It offers leveraged exposure if the long-term vision translates into better financials and much lower debt over, say, the next 18 to 24 months.
Of course, highly speculative. You're betting against the current market sentiment.
Oh, absolutely. It's a bet on a turnaround that the market is heavily discounting right now.
Yeah.
Definitely not for the faint of heart. Okay, so just to recap the Xerox situation. A tough Q2, no doubt. Significant misses on earnings, on free cash flow. Tariffs were a factor. Costs related to getting the Lexmark deal done were a factor.
But management is really doubling down on the reinvention strategy. Lexmark is central to that strengthening print, accelerating IT solutions growth.
Yeah, the path forward really hinges on executing that Lexmark integration successfully, capturing those synergies, and navigating the ongoing macro headwinds like tariffs.
It's a major corporate transformation attempt in a challenging industry.
Definitely. And remember, everyone, this deep dive is purely for informational purposes. It should absolutely not be taken as financial advice. Always do your own homework, consult with financial professionals before making any investment decisions.
Good advice.
What's the real long-term value proposition for a company like Xerox in this digital age? That's maybe the big question to think about. Join us next time for more earnings call breakdowns. Until then, stay informed and happy investing.